Hey, have you heard this one floating around? The idea that the US Federal Reserve is secretly propping up the entire banking system and none of us are supposed to know about it? I know, it sounds like something straight out of a conspiracy movie, but today we're going to dig into it. We're going to follow the money and see if there's actually something to this. Let's get started. So, this is the core claim right here. The US Federal Reserve is secretly bailing out banks without us knowing. Wow, that's a huge accusation. So, is it just talk, or is there something really happening behind the curtain? And, probably the most important question for all of us, what could it mean for our money? All right, to get to the bottom of this, we first have to find the problem itself. Some sources are calling it a ticking time bomb buried deep inside our financial system. So, what exactly is this bomb? And, how big are we talking here? Well, the number at the center of it all is, honestly, it's just staggering. $500 billion. That's half a trillion. And that's the grand total of what's known as unrealized losses, just sitting on the books of US banks right now. It's kind of like a giant iceberg, right? The real danger isn't what you see on the surface. It's the massive, hidden part underneath. So what in the world are unrealized losses? This is really the key to the whole story. Let's make it simple. Imagine a bank buys a bond for, say, $100. But then its market value drops to 80. On paper, the bank now has a $20 loss. But, and this is the important part, since they haven't actually sold the bond, the loss isn't real yet. It's just a little red number on a spreadsheet, for now. So how did banks end up with $500 billion of these paper losses? It basically happened in 3 really simple steps. First, back when interest rates were super low, banks loaded up on what they thought were the safest things possible, government bonds. Step 2, the Fed started hiking interest rates like crazy to fight inflation. And that brings us to step 3. Suddenly, all those old, boring, low-interest bonds the banks were holding became way less valuable than the shiny new bonds being issued at higher rates. Simple as that. Okay, so if these are just paper losses, why should we even care? Well, because that paper can be forced into becoming a real hard cash loss. All it takes is a crisis of confidence, a classic bank run. If a bunch of people get spooked and rush to pull their money out all at once, the bank is forced to sell those bonds to get cash. And in that exact moment, poof, the paper loss becomes a very, very real problem. And here's the thing, this time bomb actually has a timer on it. The year everyone is watching is 2026. Why? Because that's when a huge chunk of these old, low-value bonds are scheduled to mature. That means the banks are going to need a ton of cash on hand to pay them out, which puts a massive squeeze on the whole system and pretty much forces the Fed to do something before that clock runs out. So, with this $500 billion bomb just ticking away, how is the Fed planning to defuse it? Well, it looks like they have a 2-part plan. And this gets us right back to that original question. Is this a smart, responsible solution, or is it just a massive bailout in disguise? The Fed's strategy seems to have 2 sides. You've got the public plan, the one they talk about openly. This involves hinting that they'll cut interest rates in the future, which would help make those old bonds worth more again. But then, there's the second part, the stuff that happens behind the scenes. And that's what people are calling stealth easing. And get this public plan wasn't some unanimous, easy decision. The vote was 9-3. That's the most divided the Fed has been in over 6 years. It just shows you the massive dilemma they're in. Do they risk firing up inflation again by cutting rates? Or do they risk a banking meltdown by keeping them high? I mean, it's clear that even the experts can't agree on the right move here. Okay, so let's get into the more mysterious part of this plan, stealth easing. To put it simply, it's a quiet, behind-the-scenes way for the Fed to pump cash into the system. And how do they do that? By basically printing new money to buy these bad bonds directly from the banks. Someone came up with a brilliant analogy for this. They said the Fed is acting like a giant, state-run pawn shop. Think about it. Instead of forcing the banks to sell their devalued bonds on the open market and take a huge loss, the Fed steps in and says, hey, we'll take those off your hands at full price. They just move the losses from the bank's books onto their own. But here's the catch, right? Those losses don't just magically disappear. The Fed is just shifting them around, which really brings up the $1 million, or I guess the $500 billion question, who is really on the hook when this bill finally comes due? The absolute nightmare scenario that all of this could lead to is a nasty word called stagflation. It is the thing economists have nightmares about.
The analogy used to describe it as perfect. Imagine your car is running out of gas. That's the stagnant economy, the recession, but at the exact same moment, the engine catches fire. That's runaway inflation. You're stuck, and everything is getting worse. There's just no good way out.
But here's the thing. The pain from this kind of outcome isn't expected to hit everybody equally. Not at all. The analysis predicts that what we're heading for looks a lot like something called a K-shaped recovery.
And this image of a K just illustrates the divide perfectly. Picture the letter K. The top arm, the one that goes up, that represents people who already own assets. Stocks, real estate, you name it. All this new money being pumped into the system has to go somewhere, and it flows right into those assets, pushing their prices up. But then you have the bottom arm of the K, the one trending down. That represents pretty much everyone else, people who rely on a salary. And they get hit from both sides. The cost of everything goes up because of inflation, while a weak economy makes their jobs less secure.
So when you see a forecast like this, the most important question for all of us is, okay, what can we actually do to prepare for this? How do we navigate this weird new reality, especially if we feel like we're on that bottom arm of the K? Now, the source material we're looking at suggests a couple of main strategies. And just to be super clear, this isn't me giving financial advice, this is just the perspective from the analysis. First, protect the value of your money. Inflation is like a silent thief that eats away at your savings. So the idea is to look at assets that can't just be printed out of thin air. Second, try to build multiple streams of income. In an economy like this, relying on just one paycheck is like standing on one leg. It's becoming less about trying to get rich and more about just building a solid financial safety net for yourself. And all of this brings us to one final, really powerful question that we're left with. When you look at the whole picture, the quiet bailouts, the money printing, propping up these massive institutions, you just have to step back and ask yourself, who are these policies really designed to help in the end? Is it the few who are already on the upper arm of that K, or is it the many who are struggling on that arm pointing down? That's the big, uncomfortable question that this whole situation forces us to face.